After years as a leading mortgage broker and having built my own $30 million property portfolio, I've tested just about every single way to finance property. And if there's one thing that I've learned in financing my own portfolio and for hundreds of clients, it's this: not all financing methods are created equal. Some will fast track your wealth, while others will silently kill your returns. Financing trips up a lot of first-time investors. It feels complicated, overwhelming, and if you don't get it right, it can keep you on the sideline for years. But here's the thing, it doesn't need to be that way. I've helped countless clients go from confused and hesitant to clear, confident, and ready to execute, just by breaking it all down properly. So in this video, I'm going to walk through the exact financing strategies that I've used to build a $30 million portfolio, and more importantly, the pros and cons of each. By the end, you'll know exactly which strategy is right for your first investment property, without second guessing and without the stress. If you're serious about using property to generate long-term wealth, then pay close attention, because getting this right could mean the difference between years of frustration through to having a clear path to financial freedom. Let's get into it. Now, I do want to preface this by saying that this is not specific financial advice. This is purely for educational and entertainment purpose only. So with that, let's jump in. Now, the first thing you want to do is think about the strategic picture beyond just your first purchase. What are your long-term goals? How many investment properties do you want to accumulate? How far do you want to scale your property investment portfolio? Do you also want an owner-occupied property? With these questions answered, the next step is choosing a financing strategy that fits in with your goals. The way you structure your loans at the start can either help you scale faster or slow you down. Starting with the understanding of what you want your strategic picture to look like is extremely important, because it will direct what actions you need to take to get there. For instance, it may mean you need to use a trust strategy from day one, or it may mean that you need to target certain types of properties in certain locations in order to generate a certain amount of cash flow, or it may mean that you need to buy certain types of cash flow properties, which means you need to buy in certain geographies or locations. Alternatively, it may mean that you need to buy properties in different locations based on capital growth and projecting a higher capital gain in different areas. Now, the pro is, for having defined your investment goals, you will be able to move forward with confidence, understanding your own strategies, and therefore the actions that you need to put in place to make that happen. The con for this is that it can be extremely complicated. And a lot of the time, investors don't understand what they want to achieve at the end of the day. For this reason, a lot of investors end up with analysis paralysis and don't ever end up doing anything because it becomes all too complicated to push forward. Or even worse, they make a bad decision to start off their investment journey, and that experience pushes them so far off track that they never end up proceeding from there. My tip for this stage of the process is to surround yourself with a team of trusted advisors. You want people on your team who have actually built their own investment portfolios personally and do it all day, every day professionally. Having the right people in your corner is invaluable in helping you build out that strategy piece. For the strategy piece, the core team is absolutely your accountant and your mortgage broker. They're the ones that will make sure that you structure things correctly and set yourself up for the long term and achieving the ambition that you want to go after. You can also bring in property managers, financial planners, and buyer's agents. They'll have valuable insight to bring to the table and help you build your strategy out from there. Next up, you need to work through borrowing capacity. Once you're clear on your goals, the next step is understanding what you can actually execute for that first investment. And the key to that is understanding your borrowing capacity. That will dictate what is possible and ensure you're on track to purchase the right property for the right price. And the thing with borrowing capacity is it can vary significantly by lender. Take this client here. His borrowing capacity is around about 1 mil to 1.9 mil with most normal prime lenders. However, his borrowing capacity drops to $0 with some lenders and up to $2.9 million with non-bank lenders. An obvious pro tip here is that a mortgage broker can help you navigate the field of lenders so that you can find an option that's suitable for your unique situation. This can be the difference between making something work and something not working at all. The con is, if you're working through this yourself, unless you're talking to every single lender on that list, you'll never really have an understanding of what you can borrow across the market. The other thing to note is that lender policies can be extremely complicated, and unless you know the intricacies of all of those lenders and their specific policies, you may not be talking to the right lender who's actually willing to lend you money. A good mortgage broker will be able to assess your unique situation and come up with solutions-based options. If you're also looking at stretching your borrowing capacity, then they're a great resource to have on your side to have that conversation around how you can best manage risk in your unique situation. Number 3 is working out how to put together your deposit. Now, having clearly articulated your goals and having an understanding of borrowing capacity, you need to know what's possible with the deposit that you've got available. The first potential solution here is lender's mortgage insurance. If you don't have the full 20% plus stamp duty available, then that will mean that you'll need to go down the road of using lender's mortgage insurance. Now, the pro of LMI is that you're able to get into the market much sooner than if you were trying to save up for the full 20% deposit. And quite often you'll find that the rate at which you save is slower than the rate of the growth in the market. So you'll be able to get a part of that asset and be able to take advantage of the market growth rather than trying to save your way to buy that asset. Now, the con of LMI is that there is a cost associated with that. It could be anywhere of the realm of $5,000 to $20,000 in upfront, which can be rolled into the mortgage. And additionally, it will generally come with a slightly higher interest rate and tougher policies from a lender perspective. This part is extremely complicated, understanding the difference in policies and also the differences in rates and lenders' mortgage insurance costs, because they all vary significantly by lender and all at a slightly different scale. This is somewhere where a mortgage broker can add a ton of value when you're trying to navigate that piece. Finding the right solution could be a matter of tens of thousands of dollars over the course of your loan. There are also potential lender's mortgage insurance waivers. So if you're in certain professions like the medical profession, you might find that you can borrow up to 95% of the value of a property without paying any LMI whatsoever. This is obviously very advantageous, but it's not just restricted to Medico, so have a good chat to a good broker who understands what the different options are in this space. Now, there might even be options for you to get into an investment property with no cash down whatsoever. Now, the most common path here is if you own existing property and that property has some equity within it, then you can use that equity in lieu of a cash deposit. Now, the pro here is that you could use that equity as deposit, and the entire purchase of that investment property could be made up out of tax-deductible debt. This will allow you to retain any cash that you've got and either put that towards non-deductible costs or paying off non-deductible debt. Now, a con here is if you're using equity to purchase an investment property and you don't structure it properly, then this can create very complicated tax issues down the line. If you don't structure your equity release correctly, then the ATO may audit you and deem that it's non-tax deductible debt. It's important in this space, if you don't know what you're doing, to make sure you chat with your team, talk to your accountant, talk to your broker, and get the structure right. Also keep in mind that bank valuations will vary between lenders, and there could be a variance of up to 20% in the value that one bank might have over another. Therefore, there's a huge difference in the equity you may be able to access with lender A over lender B. Being able to run valuations by lender and have view of the full landscape is something that a mortgage broker can do for you. Now, if you don't own any property at all, or you're just starting out, there is still another way that you can get into an investment property with zero cash down. If you're in a position where your parents or your family own a property and there is sufficient equity within that property and they are suitable to play a role as guarantor, you can use a thing called Parental Guarantor. And instead of having a cash deposit, you can use equity in your parents' property in lieu of the cash. Now, the pro here, particularly if you're buying an investment property, is you could use tax-deductible debt for the entire purchase. That will allow you to preserve your deposit for a future purchase, say an owner-occupier, which won't be tax-deductible. And instead of putting those funds into the purchase, you can just park them in the offset account for now and save on the interest costs overall. Now, the con of a parental guarantee product is that only a few selected lenders offer it, and their criteria can also vary significantly between lenders. So it's a difficult one to navigate without the help of a professional like a broker. Your broker will be able to confirm eligibility for each lender without you having to do the legwork of talking to all. From there, you'll want to decide on your loan structure. Now, this is not a one-size-fits-all, but typically for property investors, this would be the structure that we would see. On the repayment type, your options are principal and interest or interest only. In the most case, investors will elect for interest only. This will allow them to preserve their cash flow with lower repayments. It'll allow them to build up their equity so that they can use those funds and that deposit for a future purchase or non-deductible purposes. But the con of interest-only lending is it tends to be at a slightly higher interest rate, and sometimes that will decrease the amount that you can borrow with some lenders. Secondly is fixed loans versus variable loans. Investors tend to go for variable loans, and the reason for that is there is much more flexibility with a variable loan. You could pay the debt down early, you can have an offset account mapped against it, and there's no early repayment penalty. And thirdly is an offset account. Now, from what we see, almost always investors will elect to have an offset account on their investment loan, particularly if that investment is the only debt that they've got. It's very important that you do have access to an offset account. Now, with an offset account, you can effectively make additional repayments to the loan, but still have access to your funds and your capital. You can have this benefit without it creating any potential future tax implications. So if you pay funds down into an investment loan and you then redraw those funds out of your investment loan, this can create tax complications in the future. So definitely avoid doing this and go with an offset account would be my general recommendation. Now again, it's not a one size fits all. If you've got an owner occupier with an offset account against it, then that would take priority, and that may mean you don't need to go with an offset product on your investment. Each of these options have pros and cons and potential other implications on your overall borrowing. So it's best done in consultation with an expert like a mortgage broker so that it can take you through the pros and cons and make sure you've got the right structure for what you're trying to achieve. And lastly, you want to make sure that you're finance ready and you've got in place a pre-approval prior to making any offers. With your pre-approval, you need to be careful. A lot of the times if you're talking to a bank, you might find that you get a pre-approval, but that isn't worth the piece of paper that it's written on. What you need to do is make sure it is a fully credit assessed pre-approval. Now, what does this mean? It means it's been assessed by a human rather than a system. And what it means is once you go from pre-approval to formal approval, you're not going to find that there are any nasty surprises and the bank decides to ask you more questions, risking your formal approval. The pro for having a fully credit assessed pre-approval is that you can go out and you can shop with confidence, confidently making an offer and knowing that you're covered in the case where you need to go to formal approval. Now, the con is that not every single lender offers a fully credit assessed pre-approval. You need to understand the bank that you're dealing with, the processes that they've got, and what type of pre-approval they'll give you. There are countless horror stories out there around customers that have gone out to banks, got what they thought was a pre-approval, purchased a property, and then upon going from pre-approval to formal approval, the bank declines their finance. Your mortgage broker will know exactly who these lenders are that can provide you with the right type of pre-approval and put you in the best possible position to use your pre-approval to make an unconditional offer and win a property on market. So in summary, if you're looking to buy your first investment property, then working it all out by yourself and working directly with the banks, that might work out okay. But for serious investors that are looking to maximize returns, structure their loans as efficiently as possible, and scale a portfolio as large as they can, then using a mortgage broker makes a lot more sense. A broker has access to more lender options, which means better rates, better borrowing capacity, and a higher chance of approval. They'll ensure you've got investor-friendly structuring. This means better cash flow and better tax benefits, helping you grow your portfolio faster and to a bigger size. And they'll also save time and effort for you by streamlining the process and reducing admin. A lot of people get stuck wondering if property investment is even possible for them, whether they have enough income, the right financial setup, or they hit a wall after the first purchase. The reality is though that most people can invest. It's just that the difference between those that are successful and those that are not comes down to how their loans are structured from the start. And that's why having a lending strategy is so important. If you structure things correctly from day one, you don't just buy a property. You set up a portfolio that keeps growing. It's not just about getting a loan. It's about getting the right loan with the right structure from the right lender. And that's where we at Freedom Funding can help. The process starts with understanding your borrowing capacity, not just what the bank says you can borrow, and then how you can optimize it over time. From there, we map out a strategy that aligns with your goals, not just for this purchase, but how you can get to the next one. It's a simple process, but the difference that it makes over the long run can be massive. Get it right, and you can keep growing without hitting a ceiling too early. If you're serious about starting your property investing journey, you want to build the right team to structure your finances correctly. If you believe having somebody with real-world experience and success will put you in a good position to be able to achieve that, then you've come to the right place. I'll leave a link in the description to book a call if that sounds like you. Now, full disclosure, we don't work with time wasters and tire kickers. If you're not ready to take action, then we're not the right fit. Unqualified borrowers. So if you're not in a position to meet any sort of lending criteria, then we're not for you. Unrealistic buyers. So if you're expecting to build a multi-million-dollar portfolio with barely any income, then we won't sugarcoat it for you. And rate shoppers. If the only thing that you're interested in is the lowest possible value loan product that you can get, rather than how much wealth you can generate through property, then obviously we're not the right broker fit for you. Most importantly, we don't work with people that we genuinely think we can't help. And if that is the case, my team or I will tell you up front. And with that, thanks for watching. I hope you took real value from this. We've got plenty more videos coming, breaking down property investing so it's basic, clear, and actionable. It's something you can take away. Appreciate your time, and I'll see you in the next one.